The market doesn't crash when everyone is scared. It crashes when most people still feel fine. By the time panic hits the news, your money has already been moving for weeks, sometimes months, quietly, methodically, without you noticing. Because before a market crash starts, nothing looks broken. It looks normal, comfortably normal. Let me show you what actually happens. Right now, somewhere in the financial system, money is leaving risk, not dramatically, not loudly, just stepping back. And the people doing it aren't reacting to headlines, they're reacting to plumbing, to stress you never see on your screen. And that's why this matters now. Not because a crash is guaranteed, but because crashes don't begin where people are looking. They begin where no one's paying attention. Imagine the market as a crowded theater. Everyone's seated. The show is going well. No smoke, no alarms. Then a few people near the exits stand up and quietly leave. They don't run, they don't warn anyone, they just go. Those people are large institutions, pension funds, banks, asset managers. They don't sell everything at once. That would cause panic. Instead, they reduce exposure slowly. Less risk here, more cash there. A small shift away from leverage. On the surface, prices barely move. Stocks might still rise. Crypto might still pump. The news stays optimistic. But underneath, participation changes. Fewer buyers step in. Trades get thinner. Liquidity starts to fade. Liquidity is just a fancy word for how easily money moves. When liquidity is high, you can sell without affecting price much. When it's low, even small selling causes big drops. Before crashes, liquidity doesn't vanish, it quietly dries. Now layer in debt, because debt is always there. Modern markets run on borrowed money. Hedge funds borrow, companies borrow, governments borrow. Even safe investments depend on rolling over debt again and again. That works as long as refinancing stays easy. But before crashes, something subtle happens. Interest rates tick up, or credit conditions tighten, or lenders get cautious. Suddenly, debt that looked manageable starts to feel heavy. Not catastrophic, just uncomfortable. And here's the uncomfortable math most people never see. When assets are bought with leverage, small price declines don't stay small. A 10% drop can wipe out 50% of equity. A margin call doesn't care about long-term belief. It cares about today's price. So money starts repositioning quietly. Cash becomes attractive again. Short-term bonds outperform risky assets. Boring starts winning. Nobody celebrates this. It doesn't trend. It just shows up in relative performance charts that almost no one watches. Meanwhile, narratives scramble to keep up. You hear things like, "This is healthy," "Markets are rotating," "Strong fundamentals." And sometimes that's true, but sometimes it's denial with better lighting. Because prices haven't collapsed yet, confidence remains. People anchor to what they see. Their portfolio looks fine. Their app is green. So the system must be fine too. But the system doesn't break where it's loud. It breaks where it's stressed. Then comes the trigger. It's almost never the real cause. It's just the moment the imbalance becomes visible. A bank fails. A currency cracks. A company misses earnings. A geopolitical event hits the tape. The story forms instantly. Humans love clean causes, but the truth is messier. The crash was already loaded. The trigger just pulled the curtain. And this is where your money changes behavior completely. Selling stops being emotional and becomes mechanical. Risk models force reductions. Margin calls demand cash. Funds sell what they can, not what they want. Ironically, the best assets get sold first because they're liquid, they have buyers, they can raise cash quickly. That's why crashes feel irrational.
Everything falls together. Good companies, bad companies, assets that had nothing to do with the trigger. At this point, price discovery disappears. The market isn't asking, what is this worth? It's asking, who needs cash right now? And most people only start paying attention here. They ask, why is this happening? The answer is uncomfortable. It already happened. Your money didn't disappear overnight. It was slowly repositioned long before you noticed. The crash is just the receipt. Zoom out and the irony gets sharper. The very systems designed to make markets stable, risk controls, leverage rules, automated selling, are the same systems that accelerate downturns once they start. Efficiency becomes fragility. And this cycle repeats again and again. Different assets, different decades, same mechanics. Before every major crash, the warning signs weren't loud. They were boring, subtle, ignored. Credit spreads widening, liquidity thinning, debt getting slightly more expensive. Not enough to scare people, just enough to matter. So the real question isn't when will the next crash happen? It's this: if markets fall tomorrow, how long ago did it actually start?